Hi folks, this is Stephanie. I know it's been a minute since one of my last updates, but I got a request from a viewer, I think a couple days ago, to look actually at a stock he was looking at, which is this one right here, Lakeland Industries. The ticker here is Lake. And so I was just sort of noodling it over, was taking a look at this stock through a couple of the different tools that I'm currently using to value stocks. And so I figured I'd just share some thoughts about, sort of what I guess came of that sort of small investigation. I will caveat this by saying I didn't do a super deep dive into this. I haven't actually read through like the 10K, the full 10K and stuff like that. But yeah, I guess I figured I'd share what I have with you, and you can take that what you will. So I have a couple things that I want to talk through today that I was looking at when looking at this company, and so some of these are somewhat new to my evaluation process. I'll talk through some of them as we're going over it. I'm not sure how in detail I'll go, but let's see how this goes. So Lakeland Industries. Actually, since this is not one that a company that's like super popular that most people would know of, let's just quickly look at the corporate site. So, I have that open here, and basically, Lakeland is a company that provides protective clothing. So, one obvious example is, these are like disposable suits that we've seen. Their mission is to create and manufacture a wide variety of technologically advanced protective clothing that saves lives and protects workers. So, they've got a couple of different product lines. So, disposable, like PPE type equipment, that I guess is probably the thing we're probably most familiar with. But outside of that, they also provide and supply like chemical, I guess, like suits and stuff like that, gear if you're firefighting, heat protective clothing, stuff like that, clothing, or I guess protective gear you'd wear in like sort of these like lab environments, gloves, things like that. So they've been around for, I guess, like over 30 years now. And so that's sort of just to give everyone a sense of like the company that we're talking about. So, of course, in this day and age in COVID, where we're talking a lot about PPE, kind of an interesting company to look at, but potentially one also that is, potentially quite cyclical. And so I guess we'll get a sense of, the stock as we continue going through it. But so, first of all, the first thing that I've typically been looking at when I look at a company these days is I actually start with fast graphs. So fast graphs, I guess for those that aren't as familiar, actually, I don't think I have the YouTube channel pulled up, but I'm super, okay. Um, so Fast Graphs is this tool. They actually have a pretty helpful YouTube channel where they actually go through and use Fast Graphs and this tool to talk through different Actually, you can't really see, but they go through like different sectors, like banks. They look at what else? Like pharma, stuff like that. And they also look at specific stocks. So if you want to learn more about this tool, definitely take a look at Fast Graphs because they've got some good stuff here. But in general, the way I use the tool is that it helps. The reason why I use it first is because it gives you a really quick sense of whether a stock is over or undervalued. The general idea of that sort of gears and powers this tool is the idea that in general, over time, although this is not always the case, the price and the value of the stock will always be generally in sort of lockstep with the actual earning potential of that stock, both historical earnings and then also future earnings. And so it actually tries to map out earnings growth, right, over time. So in this case, they're tracking the adjusted EPS, which is earnings per share, and they basically chart that out on a stock. So it's a little bit in this case, it's a little bit messy because the history of this stock has been a bit all over the place, as you can see. But the general idea is that they basically have a couple of different. So actually, let me just show. What's a good example? Like one I've been looking at recently is Alibaba. Let's pull that up just for illustration. But the general idea is that over time, the company has a certain like cadence of earnings, right? And so they're growing at a certain pace. And so he charts that out here on this graph. And then you've got two different reference lines that you can compare the actual price and the actual historical PE of the stock against. So this black line here actually maps month by month what is the PE of this stock for the entire time they've been public. So as you can see, it kind of like sometimes it goes up, sometimes it goes down, and it kind of is very jaggedy. And then you've got two different reference lines that you can use along with that. So this orange line is generally supposed to represent the intrinsic value of the stock based off of a PE that takes into account the actual growth rate of a stock. So they've got three different measurements here. They've got a formula that they use for low growth stocks. So basically, I think it's anything under 5%, 10%, I forget. You've got average growth stock, which would get basically an average PE of 15, and then you've got high growth stock. So if the earnings growth of the company is over 15%, it'll set the PE to be the growth rate of that company for that certain duration. So as you can see, really fast growing companies like Alibaba, for example, would have like their growth rate, I guess, has been around like 37% over this time frame. So it sets the PE here to be 36 or 37. And then this blue line is another reference line, which is basically trying to measure the historical like average of what the people think or the historical average of the PE for that stock. So basically over time, on average, what is the general premium people are willing to pay for this stock, which sometimes can be very in line with this stock, and sometimes it's a little bit different. So in this case, right, like looks like even though the growth has been really, really strong, the actual historical PE for the stock has been a bit weaker. So the general idea here, of course, is that, if you're value investing and you want a margin of safety, you basically want to find a stock where there's a gap between the current PE of the stock, right? And ideally both the intrinsic value and the historical PE for that stock, because it means that you're buying this stock at a relatively like undervalued price, because typically by both of these measures, both historical measure of the stock and both by the actual intrinsic, speed at which this company is growing, you're gonna get, there's a certain degree of buffer that you're buying the stock at. So anyway, this is just a quick explanation with Alibaba. Let's go back to Lakeland. So if you look at Lakeland, it's in some ways a bit of a hard company in stock to look at, because the history has been a little bit all over the place. And of course, recently with COVID, they've had this huge spike that's kind of thrown everything off balance. But historically, so as I'm looking at this stock, I think there's a couple of things you want to keep in mind, right? So historically, I guess just going back, right? I'm guessing, pre-COVID, it was a relatively boring company, right? Like, okay, yes, you just sort of sell protective gear. There weren't any like major events that really caused, that would really like fuel growth. So basically it kind of, it was kind of chugging along. It was basically growing. The also interesting thing about this is that it actually seems quite cyclical in some ways. Like you'll see, going back to like 20 years, right? You'll have periods where it's growing quite a bit. So it's growing at like 75%, then 30%, then it drops on to 10%. Then you see years where it's actually growing negative. Oh, so I guess this is probably, the great financial crisis probably. And then it grows a little bit, then it tanks, and then it really tanks for a couple years here where there's basically it actually goes negative. So we'll actually talk a little bit about this later, because this is kind of interesting. I wanted to actually understand kind of why it went negative, when historically in the past, they've always kind of had some degree of profit, but all of a sudden it kind of really tanked, back in 2012 to 2014. And then ever since then it kind of rebounded and started growing back up again. It was going, and then it fell down a little bit. And then of course with COVID, it's spiked all the way from, I think last year they were basically at around 41 cents earnings per share, and now all the way up to $4. So as you can see, it's a company where the growth has been pretty, start and stop. It's been pretty spurty and pretty sporadic. So that is something I think that is something to consider, right, as we're thinking about valuation, because, yes, we're in a moment of really high growth right now with COVID, where everyone's like super hyper concerned. There's this increased demand, right, for PPE, for protective gear. And the question is, how long will that last, and how will that actually affect both the short-term revenues, but also in the long term, like how does some of that persist or not persist? So, is there anything I want to talk through here? Okay, I guess the other thing while we're on this is that Fast Graphs also gives you, so this is where we're at right now, right? We're kind of like sort of midway through 2021. Fast Graphs also looks at and incorporates analyst estimates for what the future earnings growth will be for that particular stock. So in this case, it looks like the estimates that they have it going down, of course, probably unsurprisingly next year, as things kind of become a little bit more under control. So it estimates out a drop basically in half of the EPS, and then sort of like smaller, a bit more tepid growth in 2013. The other thing to keep in mind with some of these estimates, though, so there's this other feature here where you can actually look at the track record for a company, the estimates for a company. And so as you can see, the vast majority of time, even with some degree of margin for error, there is a high degree of miss rate. So you probably want to take, these numbers here with a pretty big grain of salt and probably lean a little bit more on your own inclinations and hunches for how some of this stuff will play out. I guess while we're at it, we could maybe also check Yahoo Finance. Let's see. I actually haven't looked at this myself in advance and see. So I guess the tough thing here is that the number of analysts covering the stock is really small. So you're kind of going to get stuff all over the place. But let's see. Okay. Growth estimates. Da-da-da-da-da-da. Is this just growth though? So it's not just EPS changes. Yeah, okay, so I guess, looking at the growth estimates, next year they sort of see it dropping by 50, which is probably where they got that from. Next year by 99%. But next 5 years, 10%. So, okay, that is helpful so that we can kind of keep that in mind as we're coming up with our valuation. So, cool. Okay, we've looked at this. I think that's all I want to cover on fast graphs. Okay, sorry. This is where I should check my agenda. What is the next item I want to talk through? So, talked about fast graphs, talked about corporate sites. Okay, so on the corporate site, there is a section for investor relations. Let's click on that. And let's just take a really quick look at the some of the investor presentations that they've done just to understand kind of from the company's perspective, get a sense of some of the numbers and what they're thinking about the stock. So, okay, so there's, I think, two things I want to look at, which is one, the latest update that they did for some kind of investor conference back in March of this year. So that's pretty recent. And then the last investor presentation they did in September of last year. So let's start with September, I guess, because that is... Yeah, so this is September one. Just looking at some of the key stats, right? So a couple of things that I'm looking at as I'm looking at this is that, so one thing to note, this company is actually relatively, small. It's as of, I guess, last year at a market cap of around 166 million. So something to just keep in mind as you're thinking about just sort of, the amount of risk you want to take on with this company. But okay, let's just look at some of the numbers. So net sales up basically around 30% year over year. So okay, that's encouraging. That's good to note. The other thing that I think I called out, I saw here was that, okay, so operating profit of around 10 million. So let's just divide 9.7 divided by 35. So their operating margin as of last year or last September was around like 28%. The other thing to note is that their fiscal year, for some reason, it I believe ends in, it's like one quarter off. So basically their Q4 is our Q1. It's the standard Q1. So everything's a little bit skewed with some of these stats. So just keeping that in mind. So anyway, operating margin of around 28%. Net income, right, was growing quite a bit. Also EBITDA, if we look at that, so it's basically earnings before interest, tax, depreciation and amortization, actually grew quite a bit. So it looks like it went up 4x basically from year over year. So it went from like 2.6 million all the way up to 10. So that's really good to see. They also paid down debt. That's awesome, right? We like to see that as investors. So good things just to keep in mind. One thing I also want to call it was, so it looks like previously in the past, they've also seen increased demand, right, from other pandemics that have happened in the past. So Ebola and then bird flu, both of which I guess both happened in fiscal year 2016. Let's just check back on this. Do we see I mean, I guess in this range we do see a bit of a spike, but it is, so I guess it's around 32 cents in 2015, then it spikes up. Yeah, I guess you see it spike up to $1 and then it kind of goes back to, yeah, that makes sense. So I guess that's why you saw this spike of basically 250% earnings growth in fiscal year 16, because I guess there were these major pandemics that we were dealing with at the time. So of course with COVID, it's still ongoing. So I think the revenue impact here is sort of still TBD, although clearly you see, from the numbers that you're seeing here, right? I guess to some degree you can't contextualize this because we haven't sort of looked at the historical numbers, but in general, this is quite elevated from their baseline. So yeah, clearly there has been some degree of impact. And I guess one thing that is also helpful for our evaluation later is it looks like they noted back in September that they expect elevated demand expected into first half of next year. So basically, I guess the first half of 2021, which is when we're happening right now. So that's helpful to keep in mind, although note that this is back in September. So, I think of course now here in April, we have a slightly better sense of what the trajectory of this might look like and how long some of this might last for, with just the pace of vaccinations and, sort of how this is kind of playing out globally across the world. So is there anything else? Okay, I guess another thing to note, Corona impact, because we're really interested in this, of course, because this is basically what's going to fuel probably a lot of the growth, at least in the short term. Impact will be spread over Q4 fiscal year 20, which has already happened, fiscal year 21, and the first half of fiscal year 22. So that's good to know. I think basically for me, the way I'm thinking about this is that, COVID probably is likely going to be a really big earnings and revenue driver, right, for the short term. And I'm trying to get a sense of how long to probably give them an additional boost in growth for before I kind of sort of trend it back down to what their historical looks like. What else? Okay, although they do note, though, that price increases from suppliers continue, so that's probably a sign, right, that their margins are likely going to get a bit compressed. But use of multiple suppliers has partially mitigated the impact of these increases. So that's, I think, something for us to think about as we're estimating out what the operating margins for this company might be. Because they have been, like what they said, 28% operating margin before in the past, but, potentially as, the price of everything goes up, as it has been recently over the last few months, that's probably something to keep in mind, that we might want to sort of temper our expectations there, because, it's potentially unlikely that they'll be able to maintain that going forward. So another, I guess, interesting thing to note, just to understand the split of just like segments where they get most of their sales from. I guess, unsurprisingly, a big percentage of that is from disposables right now, which makes sense given COVID. And all the other ones are probably a bit more minor. I guess another interesting thing to note is that sales by geography, so domestic, so it's actually roughly split half between domestic and international. Also helpful to note for estimating purposes. Okay, so is there anything else I want to know on this? I don't think so. I think this was basically it. Okay, so okay. Oh wait, what was that? International growth. Led by. Okay, so I guess this is also a good sign, right? Like as countries are getting more developed, they are improving their standards when it comes to probably safety, to cleanliness and stuff like that. So they can then, potentially see a bit more of a, I mean, I guess it's sort of up to us to figure out how much we think that might juice growth going forward. But something to also keep in mind that, that could also be a driver of growth going forward. Okay. Yeah, okay. I don't think there's anything else I wanted to talk about on this. And then, so this is September of 2020. I just wanted to really quickly check. So they also did a presentation in March of this year for this investor group. So they've got some updated numbers, which we can check really quickly. Let's also pull up these numbers so we can compare. So, okay, so as of September, right, of last year, it was basically their revenue had gone up around 30%. Looks like that had even continued to sort of accelerate. So that went up to like 50% as of their Q3, which is basically up until the end of the year last year. So it went up 50%. So it looks like it was continuing to accelerate. That's great. Operating profit. So let's calculate the margin here. So 12.5 divided by 41.5, which is 30%. So it looks like margins are still around 30%. It's even in some ways slightly improving. So that's really great. I mean, I guess in some ways maybe a little bit not super surprising given that, of course, as we would expect, they're, doing more business, and with more business and more stock that you're going through, you get some degree of economies of scale. So it makes sense logically that, their margin is improving. So that's really good to see. Net income continues to grow quite a bit, almost. So I guess looking at, let's say, EBITDA, it basically went from around 2 million to like 14 million. So it went up 7x over year in EBITDA, which is super great. That's really, really strong. Continued to not have debt. That's really good. And it looks like they're starting to also accumulate a decent amount of cash as they are, accelerating the amount that they're earning. So another interesting thing to note, I think basically they'd actually gone up basically like a third. I think as of the last one, let's see, they were at the market cap of just under, it was 166 million. And they've gone all the way up to 270 million. So they basically gained a market cap of basically an additional 100 million in how long was it? Like basically 6 months? Yeah, 6 months. So that of course means that, they are becoming a bit more pricey. Actually, let's see. PE was 9.5, versus 8.2. So still, I guess, relatively low, right? But the PE is definitely going up. Okay. I don't know if there's actually anything. So yeah, this is still the same as last time. Yeah, I think basically. Okay, I guess impact will continue through at least first half of fiscal year 22. Vaccine not likely to materially decrease PPE demand until mid-2021. So, okay, that's all good to know. I don't think there's anything else to discuss. Yeah, I think everything else is basically the same. Okay, so that is all helpful context. Glad that we did that. So we talked through the September and the March presentation. Okay, so now we get to the valuation part. So we've done a bunch of collecting of information just to kind of understand what the current stats look like. There's a couple of different valuation tools you can use to look at valuation. So the first technique would be to use basically Professor Damodaran, his valuation sort of spreadsheet actually. So just to recap, this is this is the spreadsheet that I built last time for that particular valuation technique. As you can see, it's like really, really built out. You've got all these different things you can punch in. So you could use this. I'm lazy and I didn't actually pull all the numbers here. So I'm actually just going to make a shortcut and use TrackTac, which is basically a DCF tool that some folks, some lovely ladies in the UK have built that basically tries to simulate the same thing, and it actually basically pre-populates a lot of the data for you so that you only have to put in the assumptions and the parameters that you want. So it actually has historical revenue numbers. It gives me the historical operating margin, so I can punch that in. For those of you that can remember, basically, when it comes to Professor Damodaran's approach, basically there's a lot of it looks at basically the data from this year, the latest fiscal year and the year before that. And then there's only a handful of places where you need to put in your own assumptions, namely the growth rate for the company for the next 2 to 5 years, and basically the operating margin, and then how fast you actually get to that target operating margin. And I guess also your sales to capital ratio as well. So those are your main inputs when it comes to doing the valuation, and then from that it basically calculates all these things out for you and then comes up with that estimate. So you have looking at the historical so these are the different parameters that we have to punch in, right? The historical growth rate for the company, let's just say, let's see. On this, so the thing is, I think the tough thing is right now we still don't have a super good sense of what the revenue growth has been year over year. Like we've got these numbers here, but unfortunately it doesn't give us the actual revenue growth numbers. The next thing I'll use actually does have that, so we can reference that. But for now, let's just say, just thinking about this, right? So, as the numbers that we saw from the presentations, it was, what was it? It was like 30%, I think it's September. Let's see. 30% in September, and then and then it was, I believe, 50% as of just most recently. So just thinking about this, so we definitely expect it to be elevated right up until mid 2022. So we expect that to, be pretty healthy, but then for it to probably drop off after that. So I think I just averaged that out to around 15%, which is why I put that here. We can sort of tweak with this later, but let's just say 15, because let's just say, assuming for, this year and next year, it will continue to be elevated. Let's say it will still continue to be a little bit elevated, in years like, let's say 3 and 4, but over time we expect some of these things to normalize. So I'm going to bring that down a little bit to 15. So that's what we'll use for CAGR, which is the compound annual growth rate for the revenue. And the next piece is operating target margins in steady state, right, in year 10. So let's see. So as we talked about in the other presentations, it looked like right now at the pace that they're operating and doing sales at, their operating margin is around 30%. So that's really, really healthy. But long term, right, I expect that to go down, because I expect right now I see this sort of as a short-term spike, as things are really bad, as there's really, really high demand for this. And over time, I expect it to probably go down to what their average target margin would be, which is around 5%. Because if you look at it, so yeah, really, really healthy in the last couple years, so 20%. But if you look at what has happened before that, it's actually been quite all over the place, because it's like 5%, then it's 4%. So it looks like on the high side, it can be closer to like, 8 to like 10-ish%, but they've also had years where it's been negative, it's been 1%, it's been 2%. So I'm just going to net out somewhere in the middle. So 5% might maybe be a little bit harsh. But we can tweak with that too. So let's just say 5% for now. Let's say year of convergence. Actually, maybe let's give it slightly longer than 5 years. Let's say like 7 years. Which is basically how fast does it get to this target margin. And then let's just keep with the same sales to capital ratio, because honestly, I actually don't know if I fully understand this yet. So we'll just stick with the default. Okay, so, and then I also made a note too, because it is such a small company, it's a pretty small cap, it's under 300 million. I did want to put a decent sort of probability of failure. Actually, I might just actually bump this up a little bit. Let's say 20%. Because they are really small. And so when you are smaller, of course, like, any potential negative impact, we'll actually talk about an example of this later, could potentially put the company at risk. And so I'm going to put at 20%, just because I do acknowledge that there is one, and that this probability exists. And proceeds, given that they've actually got like hard assets, they've got factories and stuff like that I imagine they can sell, I'm going to put at 75. This might be a bit aggressive, but whatever. So, okay, so that basically creates like the same right mapping here of like looking for projecting out what all these numbers will look like. So they've gone ahead and sort of done that for me, given the parameters. And so that gives me, so basically it projects out what all these numbers will look like for the next 10 years. It sums up the cash flows, looks at the terminal value, adds that all together, includes the probability of failure and like what I might get if that happens, to give me, where is it? The estimated, is this in millions? I think this is in millions. So I think it comes out to basically a market cap of 237 million, which is actually, I think, slightly lower than what I think they said it was 266, right? 260. Anyway, yeah. So basically that's sort of what we have as the estimate for what this company will be worth in actually no, this comes back to what we think the company is worth right now. The current price as of today apparently is $26, and the estimated value per share that I get is around $30. So in basically, in essence, if we believe these inputs that I put in, right, basically it means that the company is like pretty fairly valued right now. It's not overvalued, but it's not undervalued either. The other cool thing about that Christina and the other ladies at TrackTech built is that they've got this sensitivity analysis. So as we mentioned, right, like it's a bit of a crapshoot. We don't quite know like what the revenue will be, what the revenue growth might look like. We don't know what the margin might look like. So we actually have these cool sliders that you can use so that you can actually map out a number of different scenarios and get a sense of what the price, what the actual stock price would be given those inputs. So let's say like CAGR, like I'm a little bit, pessimistic, and let's say, let's leave it at like 7%. But I think it could be up to, let's say like maybe 25%, given that historically we've been growing for the last 3 quarters at like 30% and 50%. So let's say 25% for that year 1 to 5. And let's say margins wise. So let's say 3 to, let's say 10. 10 a good number? 11. Let's say 10. Yeah, 10, I think, which seems pretty optimistic. Okay, cool. So now I'll recalculate for us, right? Given these different growth rates, given these different margins, like what does the actual price of this look like? So that we can have a sense. Actually, no. I kind of want to drag it lower. Let's just leave it for now. We'll come back to this if we want. So CAGR, as you look at it, right? So here, just looking at the table, right now we are at $28. So it's kind of estimating that we're somewhere around here. Basically, the market is pricing in that they'll continue to grow at around an average growth rate around 7% year over year for the next 5 years. With, actually, these are all really, really tight. But I guess it's not a big spread. With a somewhere, I guess, between maybe up to like, actually with a higher margin because it's $28. But, if you believe that, okay, the margin's actually going to go up over time because maybe they'll have, they'll get to higher degrees of scale and that margin will continue to improve. So maybe like, from 5% to be 7% or 8%. And if you believe that the growth rate over time is going to be, will continue to sort of on average be 15% or somewhere slightly above that, there is room. Like if you think the margin will go up, there's a little bit of room for it to go up a little bit higher. But in general, you're not like, it's not a really big margin of safety, right? It's basically like $4. So yeah, so something just to think about. So this is a super helpful tool if you just want to do a really quick sanity check of like, okay, what do some of these numbers look like? So this is the first tool I want to talk through. I have another tool that another spreadsheet I've actually built out that I want to talk through today. So the format for this valuation comes actually from another person on YouTube. His name is Cameron Stewart. So he's basically a CFA, which is like this like very fancy designation for people who've done this like really crazy advanced test. That's really hard apparently to pass, and you basically test you on all these things that's related to like investments and stuff like that. So basically this guy knows what he's talking about. He actually has this like incredible suite of different videos where he basically runs through different companies, their 10Ks and their actual reports, their forward-looking estimates and runs through, as you can see, right, like these different models that look at these numbers to basically do these, I don't think it's quite a DCF valuation, but he goes through his valuation model, which I'll talk through a little bit, and basically comes out with a valuation at the end. So the nice thing about this is that I'd say Cameron's technique is somewhere between, in some ways I think it's a little bit easier than, and a little bit less intense than Professor Darmadaran's, where you have like a gazillion inputs you could customize and like a bunch of things that you can, customize when it comes to like, how much is your cost of equity or your cost of capital, what's the discount rate and all these things. So this approach is a little bit more simple, especially if, you're just trying to get a really quick sanity check. So I would strongly urge you to watch through some of the videos just to understand his methodology. I don't know if I'll go super into depth because he covers a lot of the basic structure, but I'll talk through at least at the high level how I kind of organize the sheet and what's basically happening here. So here I have built out this basic template, and so I have Lakeland put on here just to sort of explain the different components of this. So there are, in Cameron's sort of view, there are 5 different things that he looks for when he's analyzing a company. He wants to see positive revenue growth. So I think basically anything that's positive. So you could say, 1% passes, but in general, for me personally, I want to see something higher than that. So he looks at revenue growth. He looks at earnings growth. So making sure that's also positive, so it's not shrinking. You want to see strong cash flow. I didn't have a good stat for this, so that's why it's still blank. You want to see a low debt ratio. His threshold is a net debt over EBITDA number of, I think anything under 3x is good. I think the rationale for that being that most banks will allow you to leverage yourself up to 3 times earnings. So anything under that is like basically like handleable, and if you're beyond that, then that's sort of when things get a bit dicey. And then you look at the multiple just to understand how pricey the stock may or may not be. So that's sort of what this area is up here. So the basic structure, just to talk about this at a high level, is that so he looks at 2 different financial statements, and this section here is all the historical information. So on the income sheet over the last 10 years, what do some of these key stats look like? And also for the cash flow statement, like what do some of these key stats look like? From there, we basically want to calculate what the enterprise value of the company is over this long run so that we can calculate some of these other stats. And then on the cash flow statement part, we actually want to calculate what the free cash flow to equity, because we are, of course, the sort of equity owners. And so we want to understand what is the free cash flow to us as equity holders looks like. So we can calculate what the free cash flow to equity per share is, and then also the yield on that. And then over time, basically, so we gather these 2 different stats. He then uses those numbers to actually forecast out what do earnings look like for the next 10 years, right, up until 2030. And then from there, does the same for EBITDA and earnings, and then does the same thing for free cash flow to equity. And then he actually he comes and gets 2 different valuations. Basically, one that's more driven by the EBITDA and the EBITDA and earnings multiple, and then another valuation that's more based off of like free cash flow and comes up with the valuation at the end. He comes up with 2 different answers. He weights them. He averages them up together to come up with basically an estimate for what the 2030 price would be. And then he actually is the extra super cool thing that I really like is that he actually calculates out what the IRR, assuming that, that price is the case, he calculates out what is the IRR for that company, given that you're holding this for, ideally 10 years, and calculates out what is the IRR for that stock, assuming that you hold on to it for 10 years, and then also gives you a distribution. So that's the sort of high level view of this. And so let's just talk through some of this in detail. I will note, I think there's something strange in the data that I've pulled. I think this might come because their fiscal year is a little bit off, because this year, this number looks lower than what I would expect given the numbers that we've seen. But we'll just sort of keep in mind that the numbers here might be a little bit off because, actually, let me see if I can sanity check this. I think this source is also wrong though. Let's see, revenue one. Yeah, so okay, yeah, so this looks like it's, you know what, we're just gonna manhandle this and update this. So okay, because it looks like we are missing the last years of data. Okay, we can correct this. We'll just do it manually. So so back, it was 95 in, why does that look off? 101. Oh, that's the issue with some of these different data sources that you use. Sometimes everything's going to be a bit wonky. So it looks like 101. Let's work backward. 99. Okay. So let's just move everything up by, oh, fudge. That's not what I wanted. So we will move everything up by 1, and then we'll put, oh gosh, 159 here. Does that fix things? Why are you mad at me still? Okay. Oh my god. 159. Why is my... Oh, wait. Can I just move this up? Why is this 0? Revenue is a text and cannot be coerced into a number. Let's just say it's 0. Reference does not exist. Okay, anyway, I've completely freaked out my thing. But I think that's fine. Okay, so we updated that. So my EBITDA number might also be slightly off. Let's see. EBITDA 44. Boop, 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 boop. Wait, why do I see? Oh, wait, is this in thousands? No. 45. Okay. I can do this. I can do this. So, okay, everything is gonna get moved up. Oh god, did I move it too much? Jesus Christ. Okay, so this X copy. Okay, and then this is 45 in this latest year. And okay, so oh my god, everything is freaking out. It's a 0. What is missing? Oh, it's because it's the last number. I'm just gonna clean this up because that is annoying me. And then this is gonna be 10 too. Okay. Wait. Ugh, anyway, sorry, these things are dumb. Actually, why is that wrong? B18. Oh, 18. I want 19. But still. Wait, why is that? Oh, because it's rounded, maybe? Anyway, okay, I'm not gonna worry about that. Okay, so EBITDA we fixed. Total debt. Let's see. Total debt. Is it on this sheet? Is it on the balance sheet? Total debt 2.36. Was it 3 last year? Yeah, okay. This. Copy. Paste. Why does it... Why am I... Did I not copy enough? Okay. Control copy. And then this is... What was it? It was 2.4. 2. I'll just leave it rounded to 2. Okay. Okay, and then I need to fix also the cash flow. Okay, I'll just talk through this. So basically the general idea is that, sorry for that. Okay, so it looks like we had a pretty big spike, right, last year, which is really good. But in general, as you see, right, it looks like for the most part, historically for them, like revenue has actually stayed relatively flat, right? Like it's kind of hovered around basically almost like 100 million for like the last 10 years until recently when it kind of basically spiked almost like 50% up. Actually slightly less than that, but it almost spiked 50% up from their standard sort of like levels. They had a couple years of, wait, 86. That sounds weird. Anyway, for the most part, the general sense I get here is that it's relatively flat. So not super inspiring when it comes to revenue growth, right? Which is why when I was doing, when I was figuring out what this like, CAGR looked like, I wanted to make sure I kind of like brought it down because historically their growth rate is not very strong at all, even though yes, like, the last couple quarters has been gangbusters, but I don't expect that to be, we're not gonna be living in a pandemic all the time. So yeah, relatively flat. And then when you look at EBITDA also, let's see. So it was around 4. Actually, let me unhighlight this. It was around 4, and then it dipped down 1 year in 2014 where it was really bad. And right as we noted on this fast graphs chart, like there were a couple years there. Actually, here's this 2013. So okay, some of my numbers might be off by like 1 or 2 years. But here in 2013 looks like it really tanked. And so we'll want to kind of poke into that and get a sense of what happened there. But in general, yeah, it stayed like it's creeped up a little bit, I guess, over time. You kind of doubled from going from 4 to like basically double, but yet revenue has kind of stayed the same. That's kind of interesting and strange. But of course, like recently it's gone up quite a bit with, the revenues growing as they have. And yeah, but like on average for EBITDA, it's because it's been so sporadic, right? Like they've had years where it's not really grown, then it's really dropped, then it's kind of gone back up quite a bit. On average, I guess they net out to basically being 5% growth over time. Which is not super inspiring. Is this average? Oh, no, this is on average, it's actually -80. And then I basically tried to normalize it to get rid of some of the outliers. And I think that's when I get 5%. So in general, EBITDA growth has not been super consistent, which is, I think something to be wary of. because yeah, I think obviously that probably is a sign that, it's things potentially will be continue to be shaky going forward. Total debt over time looks like, they had a lot of debt, but that it's been brought down. We like to see that. That's really good. There is no excess cash. And then the market cap, which has, grown quite a bit over time. So that's been growing. Basically enterprise value, why is this also negative? What is going on? Plus. Get rid of that. And yeah. Okay, so enterprise value is basically kind of like, and that's like sort of like market cap, but it's basically a slightly more rich view of what the value of a company might be, because you basically subtract out total debt. This is basically the value of the company if you were to take it on, right? So you have you get the market cap, but you also have to pay down the debt, which is why you take out the debt, and then you have to add back excess cash, because you can use that excess cash to kind of offset some of the other, like the debt that you might have, and you actually get the excess cash at the end of the day. So yeah, enterprise value, for the most part has, kind of grown sort of in line with market cap. That kind of makes sense. So EV over EBITDA, that's basically the multiple that we're looking at here, right? So kind of synonymous to PE, but slightly different. So, right, because PE is typically market cap over earnings, and this is basically enterprise value, which is another measure of a value of a company, over EBITDA, which is earnings. And so why is everything dying again? Concat, why is this also broken? Let's see. Oh wait, this is because this number disappeared. Okay, this is this. Okay, now things are not complaining. Hide. Okay, so looks like the multiple here has kind of been all over the place. Like there's been, this year when they basically had very low EBITDA, and so that was really, really high. But in general, on average, I guess it's netted out to be around 23x multiple, which is, it is what it is. And then I think this is a sort of more normalized view where I took out some of the outliers, and that's around 16. So good to keep a note. And then net debt is that debt ratio that we're looking at. The general idea here is that, so this ratio basically tells you the number of years that it will take to pay off that debt. So, because net debt is basically, your total debt minus your excess cash, which is net, right? Like how much debt do you actually have over the amount of earnings that you earn every year. So on average, it looks like, okay, so it's like kind of high at the beginning, maybe like 10 years ago, but over time they've really brought it down. So it's been pretty healthy. So in general, that looks really good. We like that. This is angry again. Oh God, I'm not going to fix this. I'm sorry. Oh, should I fix it? I'll fix it later. Okay. Does that break anything? Yeah, I don't think it breaks anything. Okay, so that's the income sheet. Then cash flow, we basically start looking at okay, this is where I have to fix the cash flow number. Let's see. Operating cash flow is 40. I really should have fixed this in advance. I'm sorry, guys. And then this is 40.67. We'll round up 41. Oh gosh. Okay, so that's what that looked like. And then I probably have to fix everything again. Wait. Okay. This should be this number. It's B24 over B24. That's probably not anyway, kind of skewed. And okay, so operating margin. This is actually probably should not be in the cash flow part, but I have this here because this is like usually a column that I hide. And so operating margin historically has, as we've seen, like not been amazing. Like it's been mostly single digits. As you can see, it's kind of ranged from, let's see, around like low single digits to like, I guess 11% in a really good year. As we saw right in the presentation, it's of course been a lot stronger recently with the amount of sales that they've been doing. So I think we said this was like, 30%. So in general, though, of course, that's definitely an anomaly from what they currently have. So we'll want to take that into account. On average, it looks like it's closer to around 5%. So that's why I used the 5% before. And what's it? CapEx, it looks like they're spending, some degree consistently. That looks fine. And so I'm going to hide this again. But basically, so we look at CapEx, we also look at debt repayment. So debt repayment is basically, if it's positive, it means that they are issuing debt, so they're getting money coming in. And if it's negative, it means they've repaid debt because that's money going out. We add all of these up together to get the free cash flow to equity. This is, once again, broken. This is this. Nope. 4. Yeah. So free cash flow to equity basically gives us what the free cash flow of the company that goes actually to the equity holders, because we take out the amount of debt repayments that happen. And the reason why this is important is because it's basically this measure of, right, if you own the stock, if you're, this equity investor, this is the money that ultimately comes back to you, whether it's in the form of dividends. If the company does dividends, it comes back in the form of buybacks, or potential, and basically, yeah, the excess cash that basically comes from the operations of running the business. So looks like over time, oh my God, are my numbers off? Wait, why this looks, why that is wrong. B32. Oh, good Lord. Everything is off slightly. B24. Okay. Oh, shit. Okay. We're going to pipe this down. Does that fix things? Okay. There we go. Okay. So that fixes things. Oh, I think that's going to make my numbers quite interesting. Let's see. Okay. So shares, looks like they've slightly grown them over time, but not, I guess that's a decent percentage actually. We might want to take that into account if we want to be really accurate, but I think for the sake, I don't think I actually did it. So we're going to skip that for now. So we use the number of shares to actually calculate what the free cash flow to equity is per share. And then from there, we can also calculate the actual yield given the actual price of the company at that time. The yield comes in important later because we also use that as a factor for our value, our ultimate valuation. And looks like ROIC wise, just return on invested capital. This is basically how efficiently are they able to spend this, this capital and actually get some degree of return back. So looks like it's fluctuated quite a bit, but in general looks like it's like maybe like high single digits, which is, I actually don't know. For this, given this industry, I'm not quite sure how strong that is, but that is kind of an interesting thing to compare. Actually, let me see. Do I have stats on this? I don't know if I have a good industry here to compare it against, because it's like not quite. I think in the other track tech, I think they labeled it as apparel. Okay, I feel like apparel is like not great, but whatever. Okay, what am I looking at? I'm looking at ROIC. Let's see. Looks like apparel is typically around, 7.5%. Okay, so on looks like it's pretty average. Okay, so that's ROIC. Okay, so now we've looked at historical. The next piece basically here is to look at the actual EBITDA growth of the company, right? And start and try to forecast out what we think earnings are going to look like for the next 30 years so that we can kind of come up with a valuation. So this is where the nice thing about this spreadsheet that is cool is that it actually gives you, allows you to kind of do a more granular breakdown because, right, when we're looking at TrackTac, where is it? It basically kind of assumes that you're going to have a certain CAGR for a certain number of years. So like, as you can see, it kind of like, you can't really see, but it kind of grows at, this percent, and then it kind of just like levels off. I think basically, the way that the Professor Damodari's model works is that it basically goes, you put in the CAGR that you wanted for the next 5 years, and then it basically drops it down to like 2% over time, because his general argument is that all companies will grow at the pace of the economy, ... So this allows you a little bit more flexibility, so you can kind of control what you think it'll look like. In my case, so I have 2020, which we already have, but I basically try to map out, okay, for the next couple years, I think they will have increased growth, right? Because COVID is still happening this year. Yes, we've got, vaccinations happening, which will, alleviate some of the pain, but, the pace that vaccinations that are happening across the world is quite inconsistent. So, like, for example, in the US, things are, mostly like going in the right direction. Although, of course, you're running into a bit of a, with it looks like you're starting to run into a bit of a limit for the number of people who really want to get vaccinated. But internationally, we're also seeing this continue to still rage on, right, in countries like India, countries like Africa and stuff like that. So I mean, this might actually still be low because maybe this will still be relatively high this year, but I'm gonna expect that this is, you know it'll be it's definitely elevated. Won't be as elevated as last year, where let's say the growth was what. um are these numbers off too? Oh god, I think these numbers are off. I had to recalculate everything. Minus this over that. Yeah, okay. Then I'm gonna drag that down. Okay, yeah. So last year growth was around 50%. Okay, did I need to correct this too? Oh no, that's pulled. Okay. Do I also need to update this? Let's just update it to be safe. What am I looking at? This minus this over that gives me the growth. Why is it -3%? That makes no sense. This thing is super weird. Okay. 300%. Yeah, that makes sense. Okay, super skewed. Okay. So, okay, back to our agenda. Okay, yeah. So last year grew at around. Are these numbers correct now? Oh god, why are these weird? This thing's killing me. Okay, equals. Actually, I don't know if we have one. Okay, yeah, no, it's accurate now. Okay, we're back on track. Okay, so last year, right, we grew at basically 50%. I don't think that's probably going to continue to happen, but so I'll bring it down. It'll still be elevated. I'll use 35%. They did mention, we'll still probably continue to see some degree of, effect going into 2022, which is why I also continue to leave it elevated, but like also brought it down. I mean, it's depending on how fast you think some of these things will get resolved and things will get back to normal. You can kind of adjust it, like maybe say 20% instead of 25%. You can kind of work out all the scenarios. But okay, I'm just gonna say it's gonna be 25%. I'm gonna say after that things will maybe be a bit more cleanliness conscious, but for the most part I think we're kind of gonna go back to normal in going forward into the future beyond like 2025. So because historically on average, oh god, this number is kind of skewed, because this takes into account this number, which is gonna, yeah, so I'm pretty sure without it, let's just sanity check this really quickly. If average, what is the average of this? Oh god, that's not what I wanted. What actually undo, let's copy that. No. Okay, that didn't work either. If I calculate it again, will that work? Okay, we're just gonna make this a percentage. That is not, why? Oh, because I'm looking at that was dumb. Because I actually want to do an average of this without the outlier, which is 2%. Okay. So maybe I put 1%. Maybe that's a bit mean and aggressive. So maybe I'll say 2% because, like, there's future growth opportunities. So, okay, I'll say 2% going forward. So yeah, you can basically tweak your revenue percentage numbers here to be whatever you want, customize how you think it's going to happen. So that allows me to forecast out what revenues I think will look like. And then for operating margins, this is where, is this correct? Oh, this number is going to be off. Okay, that's also slightly off. We'll just have to take that into account. Because what was their margin last year? Actually, no, ratios. Oh, no, what happened? Okay, no, margins are probably on this page. Their EBITDA margin was 30% last year. Okay, we'll take that into account. So it was 30% last year. I think, oh yeah, we saw that in the presentation. So this should have been 30. So I think it's gonna come down. I think 25% for next year. This year seems aggressive too. Maybe I'll say 20%. So I think it will, as the volume comes down, actually, yeah, like I mentioned, they also mentioned the thing about increasing prices. Maybe we'll leave it at 25. So, they'll be at basically, this is wrong too, because this should be that. Wait, fudge. That's going to change things. I don't want to do that. Yeah, because if I do that, all the numbers are going to be skewed because it's going to go off the higher number. Actually, maybe I'll leave it as is. But I will update. Because do I think they're going to grow 35% from what they've already grown already? Maybe. I don't know. Actually, maybe I will. Should I leave it in? Because basically that's assuming, so they're at basically 160 now. That's, I think this is too aggressive. Because I can maybe see them going up to here. But then, I don't know, maybe I'll bring this down a little bit. Okay, anyway, this is where, so I'm going to make just a worksheet available for you after the fact and make this available so you can kind of toy around the numbers and do whatever the hell you want with this and see, what makes sense to you. But okay, so operating margins, 30%, I think it's going to come down this year. And then because over time, right, I think it's going to come back to normal, basically. I mean, maybe you could say this is slightly too mean, but anyway, I'm just gonna say it's gonna be like as growth is really accelerated over the next couple of years. I think it's gonna be, the margins are gonna be pretty good. Sorry, I'm thinking back to this feels wrong. Should I go back? Yeah, maybe I'll go back to. Okay, you can decide for yourself or not how you want to discount this or not discount it, but you do want to take into account the fact that if you use the existing number as is and you kind of use that to forecast, project out, everything potentially will be extreme. Like it assumes that your baseline is really high, and so all your numbers are going to go off that, in which case, maybe it's a bit unrealistic because you're not going to see this amount of growth forever. So, okay, I'll leave it as is. I'll leave it as 108. And so, yeah, the margins that I used basically was 30% where we started from, and then bringing that down over time as, the revenue growth continues to drop off, all the way down to 5%, which is basically what it averaged out to, what the average operating margin has been in the past, as you can see. That looks, anyway, slightly off, whatever, 5%. So basically what you do is then you, of course, right, you get the revenue forecast, you multiply it by the margin, you get the EBITDA forecast. And so this is what we think how that will change over time, given these parameters. Here's what the actual percent growth looks like given this forecast. And so what we do with, just to finish this out, how we actually get the valuation is we use this EBITDA forecast. So what I do is I take this, I move it over here, and then I basically backward calculate a market cap and a price from the EBITDA. So it's basically starting from like almost, so we do all this stuff to calculate what enterprise value is, and we work backward to figure out what the market cap is. So basically what we do is we take the EBITDA forecast in 10 years. We multiply that by the multiplier, right? So EV over EBITDA times EBITDA, both the EBITDAs cancel out, that gives you EV. So your 2030, assuming that, this is where you can tweak it, assuming this particular multiple, which you can punch in here to, override if you don't want to just use the average. If you multiply this EBITDA times the multiple, you get the EV, which is $252 million. And then you subtract out the amount of debt that you think the company might have. In this case, I'm just using a 1 times multiple. You can update this as well. Depending, like maybe we think that's actually kind of aggressive. Maybe, so far they've not used a lot of debt so far. We could punch it down to like 1.5 or whatever. I'll leave it at 1. But yeah, this multiple will update the amount of cash that you put in here to subtract out from that. If you want to put excess cash, you can put the excess cash here. And basically what you do is to get market cap from enterprise value, you subtract out the debt, right? Because you're taking out the debt, and then you add, no, I always get confused when I explain this. Is this right? So this is definitely right. You need to add back debt and subtract cash, I'm pretty sure. Because it should be, actually, okay, math. Market cap plus total debt minus cash. Yeah, I think this is wrong. Oh. That plus, and you subtract out cash. Is that right? No, wait, why does that feel wrong again? Oh God, okay, wait. I can do this. No. This, I swear, I've like updated this back and forth so many times. No, I think this was wrong. So, because you add debt and you subtract out cash. Oh my God. Link, go away. Okay, so you add debt and you subtract out cash. Yeah, so, okay, so that's right. So this needs to go back because you subtract out the debt that you have, then you add back the cash because you took out the cash here. Yes. Minus R8 plus. Oh God, is this right? Please be right. Yeah. No, my formula goes the other way around. R27 minus plus. Okay, we're good to go. Everything's good. Okay, so yeah. So anyway, we get enterprise value, we take out the debt, we add back the cash, and that gives us market cap, right? And then with the number of shares that we have, I just, for simplicity's sake, used the number of shares that have been available as of now. If you really want to be super thorough, what you can do is you can project out what is the pace at which shares are growing over time. You can extrapolate that out forward and then use that, but because I'm lazy, I'm just going to use 8. And then we'll get the actual price that comes of that. And so this is the price that we get if we are using an EBITDA multiple valuation. We're going to then come up with a valuation for the free cash flow side of things, and then we'll kind of figure out and we'll weight them basically so that we get something average in the middle. Okay, so with that, then we look at free cash flow. And so I think my numbers are going to be weird again. Oh, because this year is gonna be really aggressive, I'm gonna guess. Yeah. What the hell? Why is this 200? J. What is J? Okay, yeah, that's not. It's gonna go from 9 to. Oh wait, fuck. Wait, no. Yeah, this is wrong. This is this, but okay, does that make my numbers more sane? So my EBITDA forecast, okay, yeah, so it's gonna go down. That makes sense. So this is where it might make sense because I think my numbers might be a bit elevated. We'll leave. I guess we'll sanity check and see later. I feel like there might be an argument to me to like bring this down a little bit because this is once again like a bit of an anomaly. I mean, I guess we'll bring it down because the percentage will go down. Basically, what we do here is, I guess there's different ways you can do this. But the method I did here is basically I took what the EBITDA. So assuming that, oh God, this is where this number looks a bit off. Assuming, because like basically the idea here is assuming that EBITDA and operating cash flow kind of trend at the same rates. What you can do is you can take the growth over time of EBITDA, and then you can basically apply that to free cash flow to equity, basically assuming that like most of the relationship here is like relatively in line. You can take this rate, you can use that rate to basically extrapolate out for you how this free cash flow rate changes over time. And so there's like another way I think you can do it, where I think another way I've seen him run this before is you can figure out what the if it's not always kind of the same, you can actually extrapolate out a ratio of EBITDA to free cash flow to equity, and then what you can do is you can take this forecast and just multiply it by that ratio to figure out how this translates to free cash flow to equity. So does this number look sane to me? So on average, historically in the past, it's been all over the place. So it's been like couple cents to a couple of dollars, like over like slightly between like 50 to like 85 cents, and sometimes it's been a fluke and it's been really high. So yeah, okay, this I can buy this. So it's like, let's say it averages out to like a dollar something going forward. Okay, so what we do is we take this number, we bring that over here as we did last time. We get the free cash flow yield, right? That basically tells us, given the price, what is the actual yield and the free cash flow to equity that comes from it. So we can just, in this case, I'm just going to use the average is not. So the average, because it's been all over the place, has been -1. I think this is me taking the average of just the positive numbers, which is 4%. So that's what I used. And so assuming a 4% yield, basically, so the yield, right, as you remember, is basically price over the free cash flow to equity. So if we multiply, once again, the 2030 free cash flow to equity number times that rate, no, it's the other way around, sorry. The yield is actually the free cash flow to equity over the price. So if we multiply that by the free cash flow to equity, that gives us, is that right? Is my denominator in the right place? Anyway, I think it is price, right? Let's just look this up. I believe it, which is on the top. Okay, yeah, so it's free cash flow per share divided by, why does that work then? Is it multiplied? Do I divide it? How do I get this number again? Oh, it's divided. Yeah, because how does that work? It's basically free cash flow. Yeah, okay, that makes sense, because it's free cash flow on top over price times, and so I divide it, so it's times 1 over this price. So those cancel out, you get the price. Does that make sense? Anyway, that is what we get. So anyway, we multiply times the free cash flow to yield, and that gives us this price per share in 2030 of around $33.40. I'm going to weight both of these the same, because actually in some ways the band is actually quite tight, which gives us an average valuation of around $31, which is actually quite similar to what we get when we did this valuation, which is also around $30. So it looks like for the most part, yeah, like, even with the sort of more granular breaking down of this, it is still pretty, like, yeah, we're getting similar numbers. That's pretty good. But in general, if you were a long-term holder, right, so this is where if we look forward to the IRR, so the way you calculate this is that, this is the forecast of free cash flow over time. We pay, around $30 to get in this. So it's negative. And then when we sell in 10 years, we expect it to be around $31, assuming all these parameters are actually true. And then from there, basically the IRR that you get back is basically 10%. So, yeah, so in some ways, not like, actually, does that make sense? Oh, is it because it's not very high? Anyway, so yeah, not amazing, right? Not probably something you'd want to pay in the long term for. And yeah, I think I think in general, the way that I'm thinking about this is that for the most part, yeah, it looks pretty fairly valued. If you were trying to go down the value investing, methodology where you have a margin of safety, I don't know if this would be it, because, right, like, as you can see, the margin of safety is quite small. There's not much of a premium that you're getting. And so, or there's not much of a discount that you're getting when you pay for the stock right now, because it is pretty fairly valued. So yeah, I think that's something to keep into account. Of course, if you have different assumptions about how you think the world is going to play out in the next couple of years, you can feel free to update this and see what you get. Just keep in mind that every time you update all these numbers will change, right? Because it will affect your price, and then it will affect how this calculation gets generated. Lastly, the last thing I want to highlight is this IRR distribution. So the way this is mapped out is that this is the current price. I then track out the prices 10, 20, and then 33% above the current price, and 10, 20, and 33% below the current price. And then from there, calculate how the IRR changes depending on depending on what the actual price is, right? So in this case, I think it's outdated now. So because as you can see, 28 should be 10%. So I'm going to clear that. I actually also have a script that should calculate the numbers for me. Let's see if it will work. Yeah, okay. So the way it works is that basically, if you don't have the script, the way you can manually do this yourself. Oh god. Oh no, it's going. The way you manually do this yourself is that you basically just put this price into here, which will give you the updated RR, and then you kind of calculate that. I just didn't want to do it manually, so I just wrote a script for it to calculate it automatically. So as you can see, right, 10% IRR if the price stays as it is. If it drops to like $18, for example, right, you'll get an IRR of around 20%. But if it goes up, if it goes up 33%, actually, you'll get an IRR of around 5%. So I will share this I'll share this in my in the description box if you want to toy around with this yourself. But yeah, I think this is getting quite long, so I might actually just end this here. I think there might have been other things I want to cover, but okay. The last thing I just want to call out, I'm not going to go into this into detail, but one thing, so I did notice that it dropped quite a bit in 2013, so I wanted to actually understand what was going on. So what I did was, I did actually go look at the SEC file, the 10K for, I think this is like the fiscal year 2013. And in their MD&A section, they do actually talk about this because, of course, these numbers are horrible, right? You basically lose a crap ton of money. You have no profit at all. And so just to summarize, like, basically it looks like what happened was there was this, because the company is really small, so what happened was, I guess there is some company officer, that was working at the company. They somehow sued, the company somehow. And so this is like, I guess, an employee in Brazil. This court in Brazil awarded this person who was complaining, this employee, around $13 million. Looks like they were able to get it down to $8.5 million. But in general, so $8.5 million might not sound like a lot, but given that, the company itself, is only doing, right, at that point, especially, they're only doing low single digits of EBITDA a year. That's basically several years of profit. So really, really not great. And so basically, I think I just want to call that out to mention that because this company is relatively a bit of a small cap, you are going to run into these kinds of potential issues where there are things like that can happen that can severely impact the profitability of the company, and potentially, if it's large enough, right, potentially even bring the company under. So yeah, you can feel free to read this if you would like. But in general, actually, no, I think they even mentioned okay, what did they say? So they had a loan. So in addition to that, they also had declining sales. So it led to quarterly losses. They had to write off a whole bunch of money. It actually caused them to default on their loan, which of course is huge, right? Caused substantial doubt about their ability to continue as a going concern. So basically in 2013, it looks like they were very, very, very on the cusp of potential bankruptcy, right? Because it says that, okay, as a result of the default under the loan, the risk of the loan could be called as immediately due. If their bank decided to all of a sudden say, you need to pay up everything right away, they would not have been able to have enough capital to continue their operations, and potentially, right, in this case, I guess bankruptcy, there potentially could have been other things that they could have done, but it looks like they were very, very, very on very treading on very thin ice back then. So yeah, anyway, this video is getting quite long. I will leave that there. But yeah, just some sort of initial thoughts about Lakeland. Of course, I think for me, in summary, this to me does not look super attractive. I think they're sorry to lose my voice. It's not super attractive to me. I think there's a bunch of different stocks out there that offer a bit more attractive valuations and discounts and margins of safety. But know if you are interested and you want to do your own numbers and stuff like that, feel free to run that. But yeah, I will share that the link to the worksheet if you want to take a look. But yeah, thanks for your time. I hope this was helpful. Have a good one. Bye.